reaction to what was a down day for most of the time, but ended at the lows. Is this just the beginning of or a continuation of this narrative of geopolitics wagging the market?
No, I actually think today is, and that move lower is still more about the Fed than it is about Ukraine and geopolitics. Even today, if you look at the price action in a risk-off geopolitical event, you wouldn't have bond yields up 3 to 5 basis points across the curve. You wouldn't have crude a little bit lower given the involvement of Russia. So, yes, that's the latest excuse. But this retest, which, by the way, was the title of my note this week, was always somewhat inevitable. Turns out when you look at recession-related lows, they tend to be V-bottoms, but these Fed policy normalization-related corrections, it's kind of a long-winded way of saying that the Fed was the catalyst for the correction, they tend to have retests. Now, we had one every cycle up until the QE era. Last cycle, we actually had 8 of these. But if you go back and you look at 94 when the Fed started normalizing policy, or 04, the end of QE1 in 2010, the end of QE2 in 2011, or the end of zero rates in late 15, early 16, you get a first move down, and then you get about a 50% retracement more often than not, and then a retest. And they tend to last about 50 days, which is about the length of the current one. So I thought we would have the retest. For me, though, this is an excellent opportunity. Other than really putting money to work in the recession-related low, these are your best windows to actually put some money to work because, like Adam Parker before me, I think that the fundamental earnings story is still pretty strong. And I know we're struggling with this Fed credibility crisis we're having. Happy to talk about that further, but I do think we'll work through it. And from here, I think investors who are willing to put some money to work will do well.